Okay, day 10, section 2 here. Let's talk about not just the Fed, but central banks in general, right? What are the responsibilities of a central bank, right? When I say a central bank, what does that mean? Okay, a central bank is designed to oversee the banking system and to regulate the money supply, right? Central banks are designed to regulate the banking system and regulate the money supply. In other words, one of the things you could think about, one of the ways you can think about a central bank is it is a bank for banks, right? Just as people need banks to help them provide liquidity and to provide many banking services, banks could use a bank. And that's essentially what a central bank is in many ways, a bank for bank, right? Central banks appear to be an essential tool of financial development. Today, there's 170 central banks in the world, essentially one central bank for every country, right? And so while, of course, many people share this fear of big banking and central banking, as a practical matter, they're hard to live without, right? So what are the responsibilities of a central bank? Central banks have three big responsibilities. The first is, as I said, they are a bank for banks. Just as individuals hold deposits in banks, banks hold deposits at the Federal Reserve, in part because they're required to. They're required to hold required reserves. But banks also hold excess reserves at the Federal Reserve. The banks want to hold deposits at the Fed because this is one of the ways that the Fed helps them clear their interbank payments. The Federal Reserve's FedWire system transfers about $5 trillion a day, almost half the annual output of the US economy. Every day goes through the Fed, right? The Fed's also out there to be a lender of last resort for banks that need it. They help regulate the federal funds market, right, where other banks borrow from other banks. And so this is just central to having a well-running banking system and well-running financial system, is to have somebody out there that's also helping facilitate liquidity and facilitate the transfer of money. The central banks are also a bank for the US government, right? So the Federal Reserve works closely with the US Treasury. If you file your taxes and you get a tax refund, that money will come from the Federal Reserve, right? The Federal Reserve essentially is the bank of the US government. So the Federal Reserve helps manage and make all these transfers that the federal government is always doing. So one of the important things not to be confused about, though, is that the Fed doesn't control fiscal policy. The Fed doesn't say what taxes are or what government spending is. That is determined by the president and the Congress and the US Treasury. But the Federal Reserve does the banking, right? So once the policy is set by politicians, then it's the Federal Reserve's job to help facilitate the financial aspects of those policies. Did I say three big responsibilities? Sorry, I meant four. The third is that the Federal Reserve, as we talked about, is the systematic regulator of the US financial system. The Frank Dodd Financial Reform Act of 2010 that we've talked about, the Fed is now the principal systematic regulator of every aspect of the financial system. They get to, for banks, set the required reserves, they set bank loan standards, they set information requirements, they assess bank risk. They try to make sure that there's more information out there so that there's less moral hazard and adverse selection. Central banks do not regulate or control the bond or stock markets, but of course they do play an indirect role, as we're going to see, because oftentimes the Fed is involved directly in bond and stock markets in an effort to try to facilitate the stability of the banking system. So while the central bank doesn't regulate or control bond markets, they play a very important role in the process of conducting monetary policy. And then finally, there's five things I want to talk about. The fourth is that the Fed is a lender of last resort, right? The Fed, by law, right, if you actually look at the Fed's charter, they are not allowed to lend to banks that are insolvent. In other words, they cannot lend to banks that are not financially viable. They can only lend to banks when there's a liquidity problem, meaning banks that have short-term problems. So If a bank is fundamentally insolvent, then they're going to go out of bank. They're going to go out of business. And it's the responsibility of the Federal Deposit Insurance Corporation to take care of those banks. And the FDIC will pay back depositors, sell all the bank's assets, and then they will essentially eat any difference, right? It's the Fed's role to make sure that the banks have enough liquidity in the short run, right? And so they help generate liquidity and prevent banks from being illiquid, particularly in the case of a bank run, right? Particularly if depositors, for whatever reason, get fearful, like my mom that I talked about, everyone starts pulling money out of the bank. The Federal Reserve undoubtedly is doing more lending to banks simply as a way to make them less vulnerable, right? To provide them a source of liquidity if they can't get liquidity other ways. And this helps increase confidence, right, in the banking industry. And then the fifth thing that banks do here, or the central banks do, is to set monetary policy. And we're not going to talk about this so much today, but we will talk about this a lot more next week about how the Federal Reserve actually runs monetary policy. So we'll talk about the tools that the Fed uses, primarily open market operations, but we're also going to talk about the goals of monetary policy and what kind of things central banks can do and what kind of things central banks cannot do, right? How independent is the Fed? Can the Fed just do whatever they want? No. No. And so this is actually a bit of a complicated question here about how independent the Federal Reserve is. Your author says, well, if you think about independence, you can think about two types of independence. Mishkin says there's instrument independence, meaning can the central bank determine how they want to run monetary policy? In other words, what are the tools? What are the targets? Basically, can the central bank determine their own mechanism, right? Their own mechanism, their own process for determining monetary policy. And then there's also goal independence, meaning can the central bank determine the goals of monetary policy, what the central bank should be trying to achieve? By these, if we think about both of these, what we see is that relative to other central banks, the Fed is pretty independent. They have a great deal of flexibility when it comes to managing monetary policy. First off, the fact that they're up for 14-year terms helps protect them from politics, right? So this has been one of the reasons why the Fed has largely been able to withstand the Trump barrage that's taken place over the last few years, where Trump has been continually berating the Fed to lower interest rates because Trump basically lives minute by minute. And so what's good for him right now is lower interest rates, at least in his mind, that's what he thinks. And so he has, even though he is the one who appointed Jerome Powell to be the chairman of the Federal Reserve. And by the way, I think Jerome Powell is largely a respected economist and was a respected pick for the Fed. But almost as soon as Trump picked Powell, he has been trying to bully Powell into doing more. And so the fact that, members of the Fed are protected to some extent, they're not protected from Twitter and twits. They're not protected from Twitter and twits, but they are protected in the sense that the president can't really fire them, right? In the same way that he can fire other people that's in his administration. The fact that the Fed basically creates its own revenue gives the Fed a lot of power, right? There is no budget for the Federal Reserve in every congressional budget. The Fed essentially creates its own revenue, right, when it conducts open market operations. And what the Fed does is when they create revenue, they use it to pay their bills, and then what's left over, which is billions of dollars, they transfer back to the Treasury. There is something called the Employment Act of 1946 that basically gives the Fed a directive. And that directive is that the Fed is supposed to promote price stability and full employment. But as we're going to talk about a little bit later, that's pretty broad, right? That's not particularly specific. And so the Fed the Fed has a pretty broad leeway in terms of what they can set as their goals. Having said all this, the Fed is not completely independent, in part because they were created by an act of Congress, right? They're not in the Constitution. They're not independent like the Supreme Court is independent, right? There's, a president or Congress cannot abolish the Supreme Court. A president or Congress could abolish the Federal Reserve, right? I mean, it would just take an act of Congress. The Fed could be changed, right, by an act of Congress. And so in that sense, the Fed is not completely independent, right? There's definitely some constrictions, right, on what the Fed does. Let's compare this to other central banks. Particularly, let's look at the European Central Bank. We'll talk about the European Central Bank here a lot the next week or so, in part because the European Central Bank is the second most important central bank in the world next to the Fed. But also the European Central Bank is a nice comparison and contrast with the Fed. It kind of helps us think about both institutions. Interestingly enough, when the euro was being formed and the structure of the European Central Bank was debated, those countries in Europe said, okay, we're getting varied countries together that have kind of a fear of centralized power. And so we want to decentralize a lot of power, but then we don't want to decentralize power too much. What central bank would be a role model for us? The Federal Reserve. And so the European Central Bank in many ways is set up like the Federal Reserve. There are regional banks in every country that's a member of the Euro Union. And then there's a European Central Bank that's essentially like our Board of Governors, that is the executive board in charge of the central bank. So in many ways, the structure of the Fed is very similar to the structure of the European Central Bank. Having said that, in some ways, the European Central Bank is more independent from the Fed because while the Fed was just created by an act of Congress, the European Central Bank was essentially agreed to by all of its members and can only be changed by unanimous consent of every single country. So it's very difficult to change the European Central Bank. In some sense, more difficult than it would be to change the Fed. However, so while the European Central Bank in some ways is more independent than the Fed, it is less important in a very important way, and that is what its goal is. The European Central Bank is given one goal: target inflation at 2%. That is their primary goal. And so outside of that, what things the European Central Bank are supposed to achieve are much less unclear and much more contentious. So where the Federal Reserve in the U.S. has a lot of abilities to kind of, maybe focus on this and then focus on that, focus on this and focus on that. We don't see nearly that much independence among the European Central Bank, which is essentially supposed to do one thing, which is to keep inflation low. So anyway, so let's take a little break here. And then I'm going to come back and talk about whether central banks like the Federal Reserve should be this independent, right? We'll come back for section 3 in a moment.